and welcome to the Your Financial Pharmacist Real Estate Investing Podcast, a show all about empowering pharmacists to achieve financial freedom through real estate investing. I'm Nate Hedrick, and each week, my co-host David Bright and I explore stories from pharmacists all over the country who are achieving their real estate goals while maintaining a meaningful career in pharmacy. Whether you're a first-time investor or a seasoned pro, we're here to provide education and inspiration about the world of real estate. Please note, this podcast is intended for educational purposes only and should not be considered financial or investment advice. Hey, David, how's it going?
Hey, good, thanks. How you doing, man?
I am quite well, sir. It's been a busy day, but it's been a good one.
Yeah, I know you've been running around a lot trying to finish things up with this rental you've got in Cleveland. So how'd that all wrap up? How'd that come together?
It's been really good. We just placed the tenant, moved in, things going really well. We did our usual cleanup process. We had the roof replaced, and so I really wanted to get good cleaner in there to get it like deep clean before any tenant comes in. It just makes it feel more like home. And I've always found that if you can put the tenant in that position where they move in and it's in really good shape, it feels like they should move out in that same shape. So we made sure to get it all nice and dialed up for them. So hopefully they're happy. And there's always a few, I'm waiting for it. I'm just like watching my phone because it's going to happen. Whenever somebody moves in for the first time, there's always like a couple of maintenance requests right off the bat. No matter what I do in advance, it seems like that always takes place. So I'm just waiting for those to hit.
Always. Yeah, there's always something that gets missed or something that gets bumped during the move-in or something. Absolutely.
Exactly. But what was really fun is kind of during this, like we threw way too many things at once, right? We had the tenant moving in, old tenant moving out, roof replacement. And then I had the great idea to also refinance the property because I don't know why, I just like chaos. But we got to refinance the property. This was actually one that we bought back in 2019. And since that time, we got the appraisal that just came back and refinanced at that rate. We had a 40% increase since 2019, which is really great. It's been a really awesome property for us.
Yeah. And what's crazy is like, that's not a terribly uncommon story of seeing, I know, whether people are listening that have rental properties, have seen that in rental properties, or even just in a primary residence where you live now, property value increases have just been crazy over the last couple of years.
Yeah, for sure.
I know that then we've also started talking, and I know in the YFP Real Estate Investing Facebook group, there's been some discussion about where that's even going from here because, you know, we're coming to the end of the year and people are putting out their predictions of what 2022 is going to be like. And we're seeing all kinds of things across the board, but we're also seeing a lot of people saying that maybe not as hot, but continued increases are expected.
Yeah, and it's hard because nobody's got a crystal ball. Knowing exactly what's going to happen is nearly impossible. But it does, if you take a look at those things and start to weigh the risk and weigh the returns and just get in while you can and try to take advantage of the good markets and then ride out the bad, overall should be in a good spot.
Yeah, and there's definite obvious risks if you plan your investing around, well, this is going to have another 40% increase over the next 2 years. Like that's super risky. But we had a lot of questions come up on a recent webinar about like, how do you navigate this hot market, this rapid appreciation that feels risky? What do I do?
Shameless plug for the next webinar because I'm sure we'll have one here coming up pretty soon. If you have a topic, listeners out there, and you want us to discuss it in detail in a webinar, please let us know. Reach out to us on the YFP Facebook group. You can reach out via email. You can reach out on our website, yfprealestate.com, whatever. We'd love to hear about it because we're always looking for topics that interest you guys. But one issue that has come up is that it's just because it's more difficult to find a good investment, a good deal. Am I overbuying or am I leveraging too much, for example? And so that's something that I think is particularly interesting.
Yeah, and it's really interesting too to watch kind of how that's gone over several years to try to bring context to what we're doing now. Because I think if you've read real estate investing books, you've listened to older podcasts that have talked about what's gone on 10 years ago, even just 6-7 years ago. I know when we moved to Michigan, we were just blown away by how easy it was to buy like a $50,000 or $60,000 house in Grand Rapids. It would rent for $1,000 or more. I mean, numbers today that just seem unfathomable, but like we're all over the place just a few years ago. And that made it a lot more accessible for a lot of people to get in at a much lower price point that just made things a lot easier for cash buyers and things like that versus the price points we're seeing now.
Yeah, especially for newer investors like myself who've only gotten in within the last year or 2 or 3, that you've had to get more creative with larger down payments. The numbers are a little bit tighter. You've got to be smarter about finding a good deal. And it just feels like if things keep bumping up like this, there's got to be a fall, right? There's got to be something where it comes back down. And so it starts to feel less like a good opportunity and more kind of scary. And I get that.
Yeah. And so I think one of the things that compounds that is just the fear of borrowing money. I think a lot of pharmacists that have been deep into student loan debt, which is, again, super common in our world, it just feels risky to take on more debt through a mortgage. So I think one of the things that we wanted to unpack today, because mortgages are one of the things that makes real estate investing accessible for a lot of people, is we wanted to just unpack that mortgage space and do a deeper dive into mortgages.
Yeah, I think it's easy to pick up a real estate book and hear all about how creative financing and low and zero money down, and here are the partnership strategies you can use if you have no money to invest in real estate. But like most people out there and most pharmacists who are going to jump into real estate investing, you're going to be doing that with a mortgage. And so we thought, why not take a deep dive, really just talk about the concept of a mortgage, the risks and the benefits, and what leveraging actually looks like in terms of leveraging a bank's money, because that's effectively what we're doing with a mortgage.
Yeah. And I know we've said it several times that we focus a lot on this podcast on inspiration and education. Those are our two big goals. And so guests oftentimes bring inspiration. I know that people have talked about and they got a mortgage and that kind of just becomes this side note, but we want to take this time every few episodes to do these deeper dives in these topics so that these side notes do get a chance to play out as you're trying to work through the mechanics of real estate investing a little deeper in that detail-oriented sense that a lot of pharmacists crave.
And I think when you start talking about the uniqueness of real estate, and one of the biggest things that I think is unique about real estate is the ability to leverage. And that I think is essential to what makes it a possibility, right? If I go buy a share of a company, it's difficult. There's possible ways, but it's difficult to leverage somebody else's money to do that, right? I can use put and call options and a bunch of other things that I don't understand, but there are ways to do it. But in real estate, it's kind of the norm to actually leverage somebody else's money. So that ability to leverage is super important, and it allows people to invest in real estate much faster and much easier, which is really key.
Yeah, we've certainly talked about leveraging a team in other ways, like leveraging a realtor, leveraging a contractor, leveraging an insurance agent, and a home inspector, and all these people that bring expertise that you may not have gotten in pharmacy school. And that team can help. And I think leveraging that mortgage is one other way to do that. So let's jump into our deeper dive on leveraging your money through a mortgage here.
Yeah. And I think to start, right, we should zoom out for a bit of background. Let's start with some FAQs, things that maybe I get asked a lot or I hear a lot from clients, or that I see in the investment space. Like if I'm in a Facebook group or if I'm talking to other investors at a real estate investor association, one of the biggest ones I hear out there is I can get a rental property with no or very little money down, right? I've read about this, David. I only have $2,000. How many units can I buy? Is that possible?
Yeah, that's going to be a hard one. I think Lauren may have caught some people off guard last week on episode 31 when she said that a lot of new investor clients come in and they haven't realized that most lending options, most conventional lending options require that 20-25% down, like a much bigger down payment than some of the 0 down, 3%, 5% down kind of loans that exist for owner occupants. That when you are buying it as an investment property, you oftentimes have to put a bigger chunk of a down payment towards that investment property. Again, on a conventional loan, which I think is a big key. So Nate, can you walk us through for a minute, what's a conventional loan?
Yeah, and I'll preface this with my required disclaimers, right? I'm not a mortgage loan originator. I am not a lender. I am a real estate agent, but a conventional loan in its basis form is something that conforms to Fannie and Freddie Mae guidelines, right? So government guidelines. You also have some that fall into like VA loans, FHA loans that require different guidelines, but all of them basically are conforming to some sort of guidelines. So typically a conventional loan is something that is following those guidelines and that a lender is able to either sell to another bank, they can sell them to the government. They're packageable loans, basically, things that everyone can understand and wrap their head around. And so they're not held typically by a lender. They are often sold off after being finished. They're typically a 30-year rate. They're typically 20 to 25% down, depending on the property type. But again, it's something that every lender has access to and everybody can wrap their head around. And it's a very transferable or repeatable loan.
Yeah, and that's different from other loan types. Like you often hear about private lenders and when you listen to enough and read enough in this space. And so
Mhm.
private lenders are much more like if you have a rich uncle that wants to loan you money to help you get started. And so you just kind of work something out between the two of you where you pay some X% interest in order for borrowing money. And it may not put a lien on the property, may not do a lot of those things, or may not be title insurance. It's more of just like a loan between two people, that kind of private lender approach, much less official, but it can be one way to kind of take some of those guardrails off of those requirements. Similarly would be a hard money loan, which is more of someone that offers some of those less restrictive loans, but they do that for investors and they generally charge higher rates and points and things like that, fees, because they're offering a loan that no one else does. And they may allow for less money down and things like that, or they may loan on a property that's presently uninhabitable that a conventional loan wouldn't be a fit for. And then there's other specialty lenders as well, some that just specialize in lending for rental properties and things like that. So there's other loan types out there, but they're certainly not as common as the typical mortgage that you probably got when you bought your own primary residence.
Yeah. And a lot of people ask me, often I get people that come to me and say, Nate, I'm ready to buy. I just need a lender. Like, what do I do? How do I find a good conventional lender? I'm not looking to do anything fancy. I have 20% down. What do I do with that? And a lot of it comes down to starting with that real estate connection, right? Talking to your real estate agent. They know people in the business, and then shopping around. So ask your real estate agent for a couple of good recommendations. Most of them will have a couple in their back pocket, especially if they're a good agent. And they'll say, look, these are the 3 people you should call. Talk to each one of them, vet them out, see who makes the most sense, and find a good fit for you. If that is not an option for some reason, or you just don't want to go that route, you could go through something like a mortgage broker, somebody whose job it is to actually compare several lenders for you and give you kind of the best quote unquote person. Or you could simply walk into the local bank, right? You can shop around yourself. You can walk into the credit union. You can show up at the large chain bank down the road. There are numerous ways you can shop for a loan like this, but the nice thing about a conventional loan is that they're everywhere. You can really go just about any place and tap into that no problem.
Yeah, and even though these all seem like the same because they're all conventional loans and just different kind of ways to get that, there's certainly differences out there in lenders as far as response time and communication and how much education they do and those kind of things that I think can really make them a fit. Because I've heard people ask, like, so what do you mean by a fit? They all offer the same loan, but there's so much more that goes into that. And as far as in a competitive market, when you need to keep a deal together and you need the loan to close and you need there to not be hiccups, some of those experienced loan officers can be very helpful in getting those kind of things done. And that's where I think the first thing you mentioned, Nate, the Realtor Connection and some of those recommendations can be really strong because as a realtor, I'm sure you know some of those people that always come through, always answer the phone, great communicators, and those things that are just really crucial in that space.
It's actually one of the questions I ask when I interview agents for our concierge service. We're connecting people with other agents. I want them going to somebody that has a good pool of investors or banks to go to actually tap into those mortgages. So it's one of the questions we ask when we refer people. And it's, again, I would argue essential to being a great agent is having a good pool of banks and lenders that you can send people to.
Yeah. And going back to what we said a few minutes ago about pharmacists are very safety oriented. Risk is a really scary word. And so I want to unpack some more about those risks of having a mortgage. So let's start out with just on a monthly basis. If you're renting a property for X and your mortgage is Y, there's some risks there that you need to make sure there's some margin between those two figures. But kind of in general, Nate, can you talk us through for a minute what having a mortgage does on a monthly basis when it comes to just risk in general?
Yeah, absolutely. I think understanding those risks and the obvious, very upfront risk is that you have a monthly payment, right? You have to actually deliver money every single month because you have that mortgage. And so if we walk down that road, right, let's assume the worst case scenario that you buy a house and your tenants are paying you rent that is less than that mortgage amount, right? You have a payment every single month. The expectation is that you're going to have tenants covering it, but let's say that's not the case. You have to feed that property yourself for a while. Well, generally that's not good. It could actually work out in some unique situations. So let's, again, just taking a pause for a second, assuming this is what happened to you. And what would that look like if we were to say put 25% down, David, on a $200,000 house or $50,000? So we're putting $50K down on a $200,000 house. What does that look like?
Yeah, if we walk through that mortgage, and let's set up in that example, because I know we've talked a lot about the 1% rule over time, where in general, one rule of thumb that people look for just kind of back of the napkin, getting started math is you generally want the property to rent for about 1% or more, ideally, of the value of the house on a monthly basis. So in this case, that $200,000 house with $50,000 down payment, you'd hope that it would rent for $2,000 a month. So let's even say in this case, let's back that down to $1,800. Say you can get $1,800 a month in rent for that property. You've got a $150,000 mortgage because you put $50,000 down on that $200,000 house. So $150,000 mortgage is that difference. Again, just rough numbers here. You put it on a 30-year mortgage. Most people try to decide between a 15 or a 30-year mortgage. We're just going to use a 30-year mortgage for kind of simple math. Is a pretty popular option right now. Let's just use a 3.75% rate, which if you would have said that like 5 years ago, I would have thought you were crazy. And maybe 5 years from now, that'd be crazy again. Rates are just really low right now. So let's just use a 3.75% interest rate right now. And so if we put all that together, the math comes out pretty nice that the principal and interest, the principal paid on the interest, so your mortgage payment would be $700 a month plus whatever the taxes and insurance are for the PITI figure. Principal and interest come out to $700. Taxes and insurance, let's just say that the taxes are $200, insurance is $100, we get to $300. Just real clean $1,000 total mortgage payment for PITI, principal, interest, taxes, and insurance. So right now we're already, hopefully, we're in pretty decent shape here. $1,800 a month rent and $1,000 a month mortgage payment. So this is more of the situation where people try to be. Like you said a minute ago, there's situations where you could make that work if the rent doesn't cover the mortgage. There's some strategy there, but I think from a safety standpoint, a lot of folks prefer when there's some cash flow coming in. But we can't assume that that's $800 in cash flow just because you're getting more rent than the mortgage payment, because there's certainly other expenses here. Things we've talked about before are property management, that if you're not going to manage this property yourself in perpetuity for as long as you own this property, you probably need to pay a property manager to do that. Generally, that's in the neighborhood of 10% of the monthly rent. There's also going to be times of vacancy, so you need to figure something in for that. There's going to be small repairs like a doorknob breaks off or a ding in a wall that needs cleaned up and patched, repainted, and things like that. And then there's also going to be larger capital expenditures like the roof, Nate, that you just talked about that you replaced. Like that was much more expensive than a doorknob. So as you put all those things together, you're setting aside property management every month. You're setting aside money to cover eventual vacancies. You're setting aside money to cover the repairs when they come up. And you're setting aside money to cover those long-term, once in a while expenses, but big expenses. And let's just say for round numbers, you're setting aside $500 for that. And we've gotten into the detail more on that in previous episodes. And so we'll link to those in the show notes if you're looking for more of how to get into that math really deeply. But since we're focused on the mortgage, we want to do kind of the big picture view here. So $1,800 a month rent, $1,000 a month mortgage payment, $500 for these kind of set aside type expenses. That leaves $300 a month in cash flow from that rental. Again, on an average month, what you might generally expect, no month will probably ever be precisely $300 to the penny, but on average, you might expect about $300 a month. You also get when we talked about the principal and interest portion of that mortgage payment, part of that is paying down the principal. And in this case, on a $150,000 mortgage on a 30-year amortization plan, you're paying down a little over $200 a month. About $225 a month goes to paying down the mortgage each month. So really, there's an overall return on that investment of about $525 a month, $300 in cash and $225 a month in paying down that mortgage. So if we break that down, and I know this is a lot of numbers, but we'll park this stuff in the show notes too, or you can rewind and listen to this again. But if you're looking at what your cash on cash return is, that's one way to understand kind of the upside so that you can weigh that against the risk. So the cash on cash return, common metric in this case, $300 a month or $3,600 a year of predicted cash flow, divided by that $50,000 down payment, you're talking about a 7.2% cash on cash return. So off of the $50,000 cash you invested, getting 7.2% of that back on an annual basis. If you look at total return on investment, now we're up to $525 a month, where you're getting $6,300 a year return. That $525, again, that came from the mortgage pay down plus the cash flow, $6,300 a year divided by that $50,000 cash down payment. Now we're up to a 12.6% return on investment. So that shows that even with that mortgage taking a pretty decent chunk of the overall monthly rent, there's still a positive cash flow. There's still mortgage pay down coming to more than 12% return on investment for that property.
And think about how that benchmarks against other investment opportunities. I think this is something that a lot of people can call back to. For example, the S&P 500 for the last 20 years has averaged about a 7.45% return, so 7.5% return over the last 20 years. So when you're running these numbers, try to put them in perspective with something else that you can kind of quantify, right? If I stuck that same 50 grand in the S&P 500, what would I have made over the last 20 years, and what would that look like differently? And that's a good way to determine if a property is worth it, if what you're doing makes sense for your investing strategy, and if it's worth it to you financially.
Yeah, and that helps to quantify again kind of what's the potential upside, what's the potential benefit here, because then that benefit you can weigh against those risks. So then Nate, can you walk us through what are some of those risks if the market shifts? What are those risks on a monthly basis to how those numbers could change?
Yeah, and this is where I think people start to get nervous, right? This is whenever I talk to somebody who says, oh, real estate investing is risky, it's this that they're thinking about, right? The market is shifting or something happens where there's a problem, right? Like it's not the great numbers that you just walked through. We're pocketing $300 a month. It's what happens when something occurs that I didn't expect. And so I guess the first thing that could happen if the market shifts, right? We're talking about shifting downward in this case. Conceptually, if the goal is to keep the property and let it pay itself off and create strong returns over time, there's probably not a plan to sell it, then honestly, the value of the home as it stands today doesn't really matter. As long as the rent is still there, as long as it's still cash flowing, you can ride that out, right? You can stay the course, continue to collect that regular monthly income and not have to worry about what the value is. Now, where that can get disruptive is if your property taxes go up significantly or if your property insurance goes up, things like that. So if you do have a downshift in the market and you're riding out good cash flow, in most cases, as long as the rent doesn't downturn dramatically with it, you can continue to ride that out and not worry about it. And then again, as property values increase and the market does as well, rents may follow that as well. So you may actually see a longer term gain by riding that out in the short term, especially if that market dip turns into an upswing over the long term. Again, as we saw kind of at the beginning of COVID, actually, so that we've experienced this just in the last couple of years. And then if we think about the same example, if we don't have a mortgage, right, if we have no mortgage at all on this property, and so $475 a month of that mortgage payment is actually going toward interest right now, right? So David said that around $225 is going to paying down your mortgage each month, which means $475 is basically just being eaten by interest. So your ROI could actually be a full $1,000 a month or $12,000 per year if you were to buy that house in all cash. Now, the difference is that you have to pay $200,000 rather than that $50,000, right? We're talking about a no leverage situation where you're going into that and saying, I'm worried about downturns or XYZ, right? I'm worried about whatever. I'm going to buy the house in cash. So instead of leveraging that 150, I'm taking all 200 and I'm buying it all in cash. That return goes up, right? Your ROI every month goes up, like I said, $1,000 a month now instead of the $300 that it was or the $525. But that $12,000 a year is not significantly better in terms of cash on cash return, right? 12,000 divided by 200,000 is actually only a 6% cash on cash. And there's no mortgage pay down, so there's no bonus there, right? It's 6%, it's flat. So the percentage return on that example is actually lower because the initial investment is so high. So if you, again, compared that to the benchmark of throwing that money into the stock market, you would be much better off taking that 200 grand and just loading up in an IRA. And that's where the importance of risk here may be worthwhile. So there are ways to manage those downturns. There are ways to manage market shifting, but there's a downside to not taking on some risk because the potential returns are much lower.
Yeah, and I think a couple other things to remember is we're still just talking about the monthly piece. We're not talking about other appreciation, other tax benefits, other issues that exist in real estate. This is just the monthly. And I think that there's also other ways beyond making sure that that spread between the rent and the mortgage payment is bigger. That's certainly one way to reduce the risk and to increase the reward. But I think another risk mitigation thing that helps pharmacists sleep at night is some of the same things that you do just for your personal financial plan. That's having that emergency fund so that if the roof develops a problem or if you have a longer period of vacancy and you have to make that mortgage payment because a tenant's not making it for you, then you've got that there. And those emergency fund type of plans can really help to mitigate that risk over time as well.
All right. So that's monthly, right? We've broken down what this looks like on a monthly value. But what about overall property value? How does a mortgage affect that long-term look, that bigger lookout?
Yeah, I think that's a really important consideration too, because I think that plays into the overall risk reward picture. Because again, if the goal is to keep a property for a decent stretch of time, say, a 10-year period or something like that, we're really mostly concerned with the value on the day that you buy and the day that you sell, because that's going to be I either have a gain or a loss in that property. And that's going to sit on top of the monthly returns and things like that. So let's zoom out a little further than the 2-year example that you had, because I think that we've seen the same kind of trend and rise, particularly at different neighborhood levels, but we've seen some just drastic property value increases in the last 3 years that I think make this really picturesque. And again, not trying to say that what we've seen for the last 3 years we're going to see for the next 3 years by any means at all, but I think it just creates some really simple math. So let's say that you bought a property 3 years ago, for round numbers, in an improving neighborhood. So this is kind of that path of progress type of neighborhood. It's improving and values just go up drastically. And I think for a lot of us in the town where we live, we can all think of that neighborhood where that values just caught fire and properties in that neighborhood doubled. And so if you had that property as your rental, let's just say you bought a $90,000 house and it became $180,000. For round numbers, let's even say that the cash flow is much worse in this example. Let's just say it cash flowed for $100 a month and it had about $100 a month in mortgage pay down, because as the mortgage is lower, it's not going to pay down as much. So it's a little less than half the price of the prior example, a little less than half the returns. But if you would sell that house today for $180 that you bought for $90, we have to think about the kind of costs that went in there, because it sounds like amazing that you just doubled your money, but there's certainly costs when it comes to selling a house, right? So you're thinking realtor fees, closing costs, any kind of minor repairs, hopefully minor repairs, that come up on an inspection when you go to sell a property. So for round numbers, I think we could say 9-10%, maybe even a little more. Maybe we just say that you take home $160 off of a $180 sale. And if you bought that property and invested all your repairs, your total all in was $90, and you just sold it for $160, that's a $70,000 gain in just 3 years. There's going to be taxes on that. And without getting into the weeds on taxes, let's just say that magically the taxes were precisely $20,000. And so we have $50,000 gain over that time period. Those are the kind of things that can stack on top of the monthly that make real estate look like a very different investing picture as well.
And just like you said earlier, you never want to bank on that, right? Like you don't want to go into the deal thinking this only works if the house doubles in value. But
right.
The place where real estate can get crazy, or where it can really start to take off for someone, is where you buy a property and then in a couple of years, it does have that level of value increase. And maybe that takes 10 years, but even so, it's such a game changer when you get to that point of, I've been paying down the mortgage, I've been gaining equity in this property, and the value has been going up just kind of magically in the background. That's where that can really get interesting. And there are even some strategies to delay those taxes you talked about, right? That 20 grand you just mentioned, we talked about in episode 18, some advanced tax strategies. And there are several methods to delay or push around those taxes in a way that can be advantageous. So there's even more strategies within that again would be a much longer episode that can really start to get interesting.
Yeah, but I think coming back to the focus of what we're talking about today, how would a mortgage change that? If you paid cash for that $90,000 property and watched it increase to $180,000 in value, that $50,000 return on a $90,000 investment is like a 55% return, which is fantastic. But if you think about putting 25% down on that house plus some closing costs, some small repairs, let's say that you have $30,000 cash into that investment and you make a $50,000 return on a $30,000 investment because you had leverage, you had that mortgage. Now we're talking about well over 150% return. We're essentially tripling that return because you put in a third of the cash up front.
Yeah, and keep in mind, in that example, the actual sale price is exactly the same, right? The quote unquote, the return of money is the same. It's that the percentage is much higher. You could buy 3 of those properties at the same leverage, right? Or at the same initial investment. And all of them could do that, right? If in a perfect world. And so it really starts to change what you can do when you look at it from a percentage basis rather than a strict, this is how much cash I need and this is how much cash I need.
Yeah. And again, we are certainly not saying that we're going to see a tripling of home values in the next 3 years or something like that. Like, absolutely not. But I think, like you said, Nate, if you zoom out, and let's just say that in a neighborhood, you'd see that doubling over a 20-year period. Certainly the percentages are going to be different, but there's still something to leveraging that money up front so that your investment is a quarter or a third of what it would be in order to achieve that market appreciation over time, plus all the monthly returns, and how the mortgage improves those metrics pretty drastically, let alone makes it a whole lot easier to get started investing. There's a lot more pharmacists listening that probably have $30,000 that they could save up for and invest in a rental property than $90,000. By leveraging, it's lowering the barrier to entry for real estate investing.
All right, well, I'm going to play devil's advocate for a second. I'm going to talk like the individuals that I speak with who think real estate is a terrible idea. Every time I tell them I'm an investor, they're like, oh, great way to lose your money. Super awesome. Love that you're doing that. Good luck. What if the market drops, David? What am I going to do? All these numbers get thrown out the window, right? I'm totally stunk.
No, absolutely. And I think that there's definitely people out there that are trying to look into their crystal ball and they're seeing market increases. There's also people trying to look into their crystal ball and they're seeing market decreases. So that could certainly happen. And it's something that you definitely need to keep in mind, that if you're putting X number of dollars into a rental property and you're hoping that in 6 months, you're going to be able to pull that back out immediately and do something else with that money, like that's a really risky situation. Even if nothing else, then we already talked about that 8, 9, 10% or more cost that it takes to sell a property. Real estate investing is just not as liquid as a lot of other types of investing. You can't just turn on a dime and sell it very quickly. So the advice that I often hear in this instance is whatever money you're putting into a real estate investment, it needs to be money that you don't need to get at, or you don't think you're going to need to get at very quickly, because it's those situations where you have to sell and you can't hold it to ride out some of these market shifts that can really start to get people into trouble. I think another piece of risk there is depending on how you set up that mortgage. We talked about the 30-year fixed rate mortgage as what we were going for. One of the nice things about a 30-year fixed rate mortgage is it just lasts all 30 years. So you could hold that for a very long time. There are adjustable rate mortgages where the rate adjusts. People generally fear the rate adjusting up, especially where an environment like we are now where rates are super, super low. A lot of people argue, where can they go but up? So if the rate could go up and your mortgage payment could go up, that feels potentially problematic as something that could be an event that would make it so you might want to sell. And if that happens at a time when the market isn't as pretty, that could be a problem. I think worse than that would be a potential where a loan has a balloon payment that comes due. And so there are some loan types where after 5 years or 10 years or some fixed amount of time, that loan is due and it needs to be paid off or it needs to be refinanced. And so again, if that comes at an inopportune time, that can introduce risk. So those are potential problems. We also think if you're at a point where you are upside down and you can't sell that property, you particularly can't sell that property because of all the costs associated with that, that can be a problem. So I think another way to mitigate some of that risk is just finding a property where it's easy to bring in a property manager that can manage that property. If you move out of the area and you just need to hold that property, what's something that would cash flow and just be something that you could hold on to if you needed to? Because if we look back at the market over time, just like we see with the stock market, there's peaks and dips. And over time, if you really zoom out, the stock market increases. Same thing with real estate. There's definite peaks and there's definite drops. But over the really long term, it tends to have a positive trajectory. So if you make sure that your investment is something that you are willing to hold for a longer period of time to ride out a temporary market drop, that can bring safety as well.
Really great stuff. And I think it just shows the different ways you can approach this and figure out if leverage is something that you want to partake in. So let's draw a couple of conclusions. Let's wrap this up, I think, because there's a couple of points here that I think are worth reiterating. And the main focus here is that when you're talking about using a mortgage to buy a property or to buy an investment, in this case, when you're using leverage to buy an investment, that mortgage magnifies the impact of value changes, right? We talked a lot of examples of good cases where if value goes up, your returns go way up. The converse is true as well. If values go way down, returns go way down. And so whatever you're doing, that leveraging, that mortgage magnifies the impact of those value changes. That's really important to understand.
Yeah, and mortgages also change that monthly cash flow. So if your rent is X and your mortgage is Y, you've got that spread to work off of for all your expenses and hopefully some remaining cash flow. If you don't have a mortgage on that property, that cash flow gets a lot bigger, but then you also have to invest a whole lot more money to buy that property than the more limited amount that you need to buy with a mortgage.
Yeah. Another interesting thing is that if you have $100,000 to invest, let's say, and you could buy one property at $90,000, or you could buy three properties at $30,000 each, all with mortgages, or better yet, $30,000 down with mortgages. That can magnify your returns when it comes to capturing that market appreciation. And if you're worried about, hey, Nate, three properties sounds like a lot. That sounds like I'm just asking for more risk. You can diversify, right? You could buy in three different states or two different neighborhoods, or there's lots of different ways to manage that risk, spread it out over the longer term, so that no matter what you're doing, you've got some built-in ability to be flexible and to capitalize on the returns when they're there and to limit the risks when they pop up.
Yeah, and I know that as we talk about current market conditions and current prices, one of the other advantages to a mortgage and getting comfortable with the risks, understanding the risks and learning to mitigate those risks is that having that mortgage can oftentimes make investing tremendously more accessible to most investors out there that don't have hundreds of thousands of dollars of cash lying around to go buy a property with cash.
Yeah, and finally, if you really are thinking about this from a risk standpoint, and again, let's tie it back to something that a lot of people understand very well, which is the stock market. If you had X amount of dollars to put into the stock market, would you buy one stock and hope that everything worked out perfectly with that one stock and then it was just going to ride there? Or would you diversify across multiple properties using or multiple investment strategies, multiple shares of different companies, right? That helps you to diversify. And it's the exact same thing in real estate. Using leverage allows you to diversify more quickly to spread out that risk even better.
Yeah. So thinking about that all, if we had to try to boil this down to just a few things to keep in mind, Nate, what's one thing that stuck out in your mind today?
Yeah, I think the thing that I always come back to and the thing that I tell a lot of my clients is that if you intend to hold a property for a long period of time, if you are truly in real estate for the long game, it does not cost you money to hang on to something, right? It's better in that case to deal with the market increases and decreases over time. And as long as you don't need to access that money quickly, and again, I'll say that again, real estate does not allow you to very often access that money quickly. It's worth your while to play this game, right? It's worth it to get in and use that long period of time to ride those increases and decreases over that longer term period.
Yeah, and I would say also, to echo one of the things you said earlier that stuck out to me, is that mortgages really magnify the gains and they magnify the risks. And so that can all be mitigated if you're very intentional and very strategic about what you're doing, to make sure you have an emergency fund, to make sure you've invested wisely, you've engaged a good team to make sure it's a good house in a good area, all those kind of things. You can help to mitigate against those risks, but mortgages will magnify those risks and they will magnify the rewards. So if you can work through that mitigation strategy to make sure that you're comfortable with those risks, then mortgages can make investing so much more accessible, so you don't have to save for years and years and years and years to try to get hundreds of thousands of dollars together to try to buy a property.
Great stuff, David. Really appreciate the deep dive discussion. I think this is going to help a lot of people. And again, if there's topics that you guys want to hear more about, webinars, podcast episodes like this, deep dives, please reach out to us. We would love to hear from you. You can find us on yfprealestate.com or head on over to the YFP Real Estate Investing Facebook group. Become a member if you have not already. We'd love to engage with you guys. Love the chat. So again, thanks for joining us and hope you picked up some tips today.
Thanks for listening to the YFP Real Estate Investing Podcast. If you like what you heard on today's show, please leave us a review and subscribe to the show so you never miss an episode. If you have a question, know someone that would make a good guest, or want to connect with Nate or David, head on over to yfprealestate.com and join the growing YFP Real Estate Investing Facebook group. As we conclude this week's episode of the YFP Real Estate Investing Podcast, an important reminder that the content in this podcast is provided to you for your informational purposes only and is not intended to provide and should not be relied on for investment or any other advice. Information in the podcast and corresponding materials should not be construed as a solicitation or offer to buy or sell any investment or related financial products. We urge listeners to consult with a financial advisor with respect to any investment. Furthermore, the information contained in our archived newsletters, blog posts, and podcasts is not updated and may not be accurate at the time you listen to it on this podcast. Opinions and analyses expressed herein are solely those of your financial pharmacist, unless otherwise noted, and constitute judgments as of the dates published. Such information may contain forward-looking statements which are not intended to be guarantees of future events. Actual results could differ materially from those anticipated in the forward-looking statements. For more information, please visit yourfinancialpharmacist.com/disclaimer. Thank you for your support of the YFP Real Estate Investing Podcast. Have a great rest of your week.